Okay, Jim.
Okay. Good afternoon, everybody. Greetings not from the beautiful city of Trieste, because we're going to be doing this remotely today, unfortunately, and we hope in 2021 to be seeing as many people as have joined into this forum today. This forum is about funding the recovery phase, developing local capital markets to finance growth and increase liquidity. You know, we realise that we're just going through one of the one-in-a-century crisis that we've seen here. I'm not saying I'm old, but this is my 5th pandemic, and this one is actually more significant than any of the others that I've seen. So, for our forum, I would like to introduce a few people. The first and foremost is Peter Tabak, who is the Associate Director and Regional Lead Economist for the Economics Policy and Governance Department of the EBRD. And Peter is going to set the scene for us by giving us a broad macroeconomic summary. We have Thierry Clark with us, who is formerly of Schroders Asset Management, but is the founder and Chief Executive Officer of Investor Connected, based in London, which looks to service and provide finance to SMEs. The other arrow in Thierry's bow is that he's just finished a couple of transaction cost studies in the Balkans and can provide some background on how the markets are operating. We have Anna Gefasoni, who is the General Manager of the Italian Private Equity Association, Private Debt Association. And lastly, but certainly not least, we have Polly Pentidou, who will be available to take any questions that you have on the chat line. So I would encourage you to immediately raise any questions at all through the next hour or so. We probably won't go as much over time as the insurance people did, right? But let's see how we go. Okay, so without further ado, I put it across to Peter Tabak to give us a little bit of an overview of the macroeconomic environment which we face from here on in.
Thank you very much, Jim, for the introduction. And there was already quite a lot of talk about the macroeconomic environment in the previous sections, and it's not by chance that the macroeconomic environment has such a prominent space now in the financial markets, because there is a unprecedented uncertainty about the forecasts because of the still unknown, not completely known effects of the epidemic. The EBRD has published its forecasts in mid-May after the IMF and before the World Bank and the European Commission published their forecasts. And more or less, the forecasts are in the same ballpark. There are some differences, but we see the main effects of the epidemic very similarly, and also we see some difference in the recovery, but what we see already recovery in 2021, not necessarily a full recovery. Our forecasts were based on the assumption that the epidemic will not have a second stage or a return sometime later this year or early next year. So there will be this effect of the lockdowns in the past 1.5–2 months, basically, and recovery probably starting in the third quarter of this year. And this region, so the Southeastern European region, will be, according to our forecasts, more or less similarly affected as the Central European region, less affected potentially than Western Europe and some other regions. But of course, there are big differences among the countries. So we see definitely two distinct groups in the region. The most affected country group is those which have a significant reliance on tourism sector, above 20% of the GDP, and this is Albania, Croatia, and Montenegro. In these countries, we are expecting a recession of 7 to 9% this year, and a slower or faster recovery next year. The other countries are either relying more, have a more diversified economy, or they have a strong industrial base, like Bosnia and Herzegovina or North Macedonia or Serbia, and they will be mostly affected by the disruption in global supply chains, and also the heavy disruption in the services, especially personal services sector, during the lockdown period. But overall, we expect them to be less affected than the tourism-related countries. And overall, in the Western Balkans, we are expecting around 5% decline this year, and a relatively fast recovery, jump of the GDP, and 7%, somewhat above 7% next year. There was quite a lot of discussion already about the fiscal effects of the epidemic, and this fiscal effect is twofold. One is through the lower GDP this year, which is already increasing the debt levels and, of course, also the deficit levels. And, of course, the deficits will increase because of the mitigating measures the countries are introducing in the region. These mitigating measures are quite similar in most countries. They are providing some support for the companies to keep their labor force, providing other types of grants for the companies. SME guarantee programs are also quite widespread. Sometimes governments are providing also one-off payments to individuals, and there are lots of other types of measures as well. But these are mostly focusing on the immediate mitigation of the effects of the crisis. And of course, we will see what will be in the potential next measures, which will have to focus more on the longer term, dealing with the longer term effects of the crisis. Nevertheless, the budget deficits will increase quite significantly, so they go up to, in some cases, potentially above 10% of the GDP, like in the case of Montenegro, or up to 7%, like in Serbia, according to the IMF. But in any case, the increase in the deficits will be at least 3 percentage points of the GDP. So really an increased supply of government papers, and also an increased need for external financing is what is expected. The IMF has provided already quite a lot of support through this rapid financing instrument for Western Balkans countries. EU is also providing funding. World Bank, EBRD, and other international financial institutions are also there to provide financing. But in any case, the financing need from the local markets will also increase. So this can have a dual effect. First of all, potentially decreasing the liquidity available for the private sector financing of the banking system, and also it might make it more difficult or it might also increase the financing costs for the governments from the local markets as well. Also, the external balances at least in the Western Balkans, have been the external financing needs have been quite high in previous years. This was mostly covered by the quite significant foreign direct investment inflows, which might decrease somewhat because of the uncertainty due to the epidemic. And this can create some financing issues or provide some need for other external financing. And some countries have already increased their external issuance. Serbia issued recently Eurobonds, and also North Macedonia and Albania is also planning to issue, and some other countries might also follow on this as well. All this, so the slowdown of the temporary slowdown might create some issues with the longer term convergence, especially in the Western Balkans countries, which have been growing slower even before this epidemic hit them, slower than the Central and Eastern European countries, despite the overall lower development level. So it will be very important to focus on those structural reforms which can help to accelerate growth after the crisis. And these are quite numerous. Mostly, it will be mostly important to focus on building proper economic institutions. It includes also strengthening the financial markets as well, because Southeastern Europe is very much focused on bank financing, and it would be also important to strengthen the non-bank financing opportunities as well. And in this respect, there is still quite a lot to do. So the stock market capitalization has been quite low, well below, of course, the EU levels. But most importantly, the stock market turnovers have been extremely low. So despite having relatively large number of quoted stocks on the stock exchange in some of the Western Balkans countries, like in Bosnia or Serbia, there is almost no turnover in these stocks. There is no liquidity, there is no institutional investor base which would create proper demand for this. It's mostly Croatia which has a strong private pension fund base, where there is some stronger turnover on the stock exchange. So it would be really important to focus on building the institutional investor base to increase the capital market liquidity as well. Some countries are already working on it. So Serbia has started to develop capital market development strategy, and some countries might also follow up on this. And that's a good sign, because it seems that there will be new opportunities by, for example, by the central bank actions, which are also focusing on more active participation in financial markets to really develop more active financial markets in these countries. So that's for starting.
So, Peter, thank you for the broad summary, the scene setting, if you like. I think we all recognise that the financing needs are huge for the region, regardless of whichever way that we look at it. It is gratifying to see that Serbia and North Macedonia have tapped the international debt markets for some, well, could potentially be cheap form of financing, et cetera, et cetera. But of course, no single source is going to be enough to get us out of this, what is effectively a horrendous truncation of growth over the next couple of years. And potentially we are assuming that we are going to see recovery in 2021, but we're really not quite sure from what level. So one of the things that this actually suggests is that government expenditures are going to be very, very tight, and that the government is going to need to tap the market and the local capital markets for some of their forms of financing. So I'm going to open up the question to Thierry, Clark and Anna. The capital markets of the region are really, really underdeveloped. Is it now too hard to develop, and should we just rely on the banking system, or what should we do to get first level coverage into the capital markets of the region? And is it now a priority, and what area becomes a priority in this environment to fund the recovery phase? I'll start with Anna, and Anna, you're muted.
Okay, thank you very much. Good afternoon. So for me, capital market, of course, it's very important. So in a country, in a region, we need to have both a good banking system and a capital market, of course. And also for banks, it's important to have capital market because, for example, banks that are listed in many, many countries, and we have investment banks are working a lot to promote capital markets. So it's not correct to say banking sector or capital market. We need both, of course. So the point is how to develop capital markets. In Italy, for example, we started many, many years ago trying. So we have a capital market, of course, and also we have large private capital markets. So we have private market, public market. So we have many things in our capital market, but to promote, to stress the importance of the capital markets, we need, first of all, to develop what is not stock exchanges. So I mean funds, private debt funds, private equity funds, venture capital funds. We need to promote platform like lending platform and crowdfunding platform, because companies, small companies need to grow. So we need to have different segment in the market, and we have to promote first of all what I call the bridge between the only banking sector scheme and the capital market scheme. So we need many, many actors, many players. And what you need to develop capital markets, for example, is to have funds investing in small caps. This is very important. So in our country, for example, we had and we have many incentive to launch small caps funds, because a market, as you know very well, is supply and demand. So you need to create demand, giving finance, growing finance to small companies or startup companies, and you need to provide finance in capital markets with small caps funds.
Okay, thank you, Anna. And Thierry?
So I'm gonna tackle this from kind of two perspectives, but I'm going to start at the top down. So when we look at capital markets, generally we're speaking about kind of mid caps, medium-sized businesses, larger sized businesses, and effectively with capital markets, there's two sides of the coin in Central and Eastern Europe, Southeastern Europe, which needs to be kind of addressed, and that's one of issuance and the other one of trading. And then I'll come on to kind of SMEs a little bit later. When it comes to issuance, there's four things really that are challenges which are either not being solved or partially being solved that are worth looking at, and we can jump into these in more detail if you wish. The first of all is the banking sector is necessary but not sufficient. And so coming out of the crisis, funding is going to be necessary for all businesses, and therefore the more capital markets, the more sources of funding that we have available, the more taps that are kind of turned on, the quicker the bath is going to fill up. So when we're looking at issuance and we're looking at either equity or bond issuance, the things that we need to consider are cost effectiveness relative to banks, the operational efficiency, i.e. how long does it take to affect a capital market issue, the availability of capital, and then finally the transparency and governance, and the requirements placed upon the companies that are going through that process. Now, these four aspects of issuance all have potential regulatory and market consequences, and without proper structure and structures which encourage issuance, you're not going to get the companies wanting to come to market in the first place to be able to tap the market. So Jim mentioned the study that we did on the Western Balkans, and one of the biggest things that we realized from that particular study was that there is a challenge in terms of cost effectiveness. There are no caps put on certain fees in certain circumstances from the regulators. There is potential time delays with regards to issuance of bonds. Now, all of these are challenges which banks don't have, or bank lending doesn't have. So you need to make it attractive for companies to want to come to market. The second thing is about liquidity. Now, clearly, capital markets need to be liquid, and many Southeastern European markets are not liquid. There's a lot of historical baggage to unpack there. There are a lot of companies which are listed which probably shouldn't be and would choose not to be if they had the opportunity not to be. And so, although the market may look deep, it probably in reality isn't. And so, you need some mechanisms to be able to start liquidity, because you get into vicious cycles. So, for example, a lot of pension funds and insurance companies, and also some asset management companies, will have value at risk limitations, and part of value at risk calculations is looking at liquidity. And when it may take you 2-3 years to unwind a position, it's very, very difficult to invest in local markets. That also is compounded with the fact that you also have a lot of regulations, whether that be pension or insurance regulations, that make it in many respects nigh on impossible for local investors to invest in local markets. So there are a number of issues which need to be dealt with. There are some good structures which are there. There is institutional capital available. There is institutional capital that could be used to put into markets, but the mechanisms and the restrictions are somewhat challenging and make it more difficult to do so. I'm talking at a very high level here, but we can dig into anything that you want to. Finally, Anna was talking about SMEs and investing in small businesses and micro investments, and talking about crowdfunding and those types of things. Now, whilst these mechanisms are all very, very interesting, and I'm involved in a lot of these types of initiatives here in the UK, I think there's a level of sophistication that comes with these types of initiatives that's not yet there in a lot of Southeastern Europe. And as a consequence, sometimes it's better to focus on the fundamentals to try and get people interested in investing. And one of the results of the studies that we looked at in the consultation in the years and years that I've spent in the markets is that tax incentives are one of the best and easiest ways of getting people to put capital at risk. Now, obviously, we're in a much more risk-on environment, and that risk is higher. So the tax incentives would potentially need to take account of that. But making sure that you introduce systems and processes that encourage private capital to come into the market is also extremely important.
So thank you a lot, Terry. You've given us quite a lot to think about. We've obviously, particularly in this region, we've got a sort of duality that exists. We've got the small and medium enterprise, which is struggling to get access to finance, and then we've got the larger institutions that do need to borrow to fund their shortfall in capital. Peter, I just want to revisit just very quickly. Thierry suggested a couple of ways to encourage investment flow into the region. Do you have any other suggestions rather than tax incentive and streamlining documentation and improving the basic function that exists? Is there anything else that immediately springs to mind?
Yes, indeed, it's a very important question, and there was probably a bit too much focus on the more tangible benefits which were offered for foreign direct investors, and basically grants and other types of benefits. But there was a much slower movement in generally improving the business environment, which entails a lot of things, including reducing different bureaucratic issues, which you can see basically if you are looking at the World Bank Doing Business Index or other competitiveness indices. So especially the Western Balkans region has a huge bureaucracy still, which is not really efficient and quite intrusive, especially for smaller businesses. So reducing this type of bureaucracy and making it more business friendly, introducing one-stop shop administrative windows which are making any administrative burden easier, reducing the intrusiveness of the business inspections, focusing them more on the informal businesses which are creating an unfair competition to the formal ones. So these are very important to attract more investment, both foreign investment and also increase the local private investment, and also the reducing still further the footprint of the state. That's also an important issue, because state-owned enterprises are still taking up too much of the economy, especially in the Western Balkans, and they are not just competing with local private enterprises or foreign enterprises. There are lots of examples for this, and of course they are enjoying subsidies which private companies and other advantages which private companies do not get. But also some of them which are providing very important services for the private sector, they are providing bad quality services and at high prices. One example is, for example, the telecommunication companies in Bosnia, where basically the 3G is still working instead of 4G in other parts of the Western Balkans. So all these are definitely holding back private investment, private inflows. And Thierry, and also you mentioned the issue with relatively small and fragmented capital markets, also high cost of entering these capital markets. So all these are adding together, and it would be very important to focus on a holistic and strategic way to reduce these types of burdens or barriers to entry into these markets.
Okay, and that's great, because now I'm going to put Thierry and Anna on the spot and say, okay, I don't care which segment you're looking at, whether you're looking at the primary market, the big ticket market, or the SME market. If you were a policymaker, what would be the three things that you would look at doing to impact and to create the local capital markets as a viable financing channel? What would be the three top priorities? And this time I'll start with Thierry.
Yeah, you have put me on the spot there. So what three things would I do? I mean, so the first thing that I would do is try to look at liquidity, because that with increased liquidity comes more options and opportunities. It makes the market far more attractive, both domestically and internationally. And Peter made a very good point when it came to state-owned enterprises. In pretty much all of the markets, Southeastern European markets, there is still a large ownership of listed, the largest listed companies being still SMEs, and also having a very low free float, which means that the largest companies have sometimes zero liquidity, or close to zero liquidity. So making sure that you create more liquidity through releasing of government stakes and the most attractive and largest companies in the market, that's one way of doing things. I think the other thing about liquidity is also potentially pump priming. So economists know about pump priming, but creating artificial mechanisms to keep the flow of liquidity going, and that may require some solution engineering in order to do that. But we've seen it work in other markets to have where you have institutions or funds or organizations that have that are quasi-governmental organizations that have the sole purpose of creating liquidity as well. So I think making sure that you have that, because the challenge at the moment is that part of the illiquidity is that you don't have enough the other side of the trade. So without market makers, it becomes very, very difficult. So you need to create some form of market maker to get the thing moving in the first instance. I think the other thing that can be done is changes in regulation to release institutional capital. So to allow institutions to invest in IPOs, in small caps, in other domestic asset classes, bonds, for example, that are not rated but are local. So allowing a little bit more flexibility when it comes to institutional capital to get it into the market, so that private companies know that there is capital available to be invested. Those are the things that I would do, and also the tax incentives thing. I still stand by that.
Okay, that's great. And Anna, your feedback, and you're muted.
Okay, sorry. I completely agree. So first of all, you need the flexibility. So it could be nice to have a sort of free rules area for 2 or 3 months, 6 months, 1 year, to create the market, because we have many bureaucracy, many rules. It's so difficult, first of all, for small caps and mid caps to go public with this very heavy bag full of rules. So flexibility, of course, looking through the reason you company decide to go public, to go to capital markets. Second, of course, liquidity. Liquidity is very important. So you need to push many funds, not only at local level, also at international level, dedicated to those markets. And of course, it's necessary to have a very strong private capital industry, both for private debt and private equity, because the energy of those funds when they are inside a company is very important to go to capital markets in a second step.
Okay, that's great. We've just received a question, and it's germane to your area, Anna, so I think I'll just briefly ask it, because it's part of what you were saying. Is there any estimate about how much local PE or venture capital there is from the Balkans, and how much comes from EIF as well as other non-European sources? Is there any actual available investment that we can look at the segmentation of the PE and VC area?
So I think to develop the VC area, it's very important to have European institutional players because it's necessary to have this kind of player, first of all, for high-tech companies, because high-tech companies are not local. So are local for a few weeks. Then they are international, European. They need to go through Europe and through the world to develop their business. So it's necessary to have both local players, first of all, seed money players, at local player working together with universities, for example, working together with a research center, but immediately in the second round, in the round B and C, we need to have international player, and the role of European funds is crucial in promoting this kind of activity all over the Europe.
Okay, now, all right. So we've spoken about the generalities of capital markets, and you know, I'm actually in full agreement with you. Part of the thing that we need to do in the Western Balkans and also in Southeastern Europe is to get rid of some of the long-term legacies that we have seen as a result of the mass privatization. So things like getting rid of the large amount of dormant share accounts, the large number of companies that are presently listed on exchanges, et cetera, et cetera. Now, we understand that this is a priority for developing liquidity, but there is another interesting segment, which is 95% of the market in this region is dominated by SMEs. And we saw a much earlier comment by Rick Watson from APMA that the access to capital market to finance for SMEs is absolutely critical, but they're not seeing it. And the other thing is they're not seeing it, but they're not seeing the right type of capital because they don't presently need loans, they probably need equity. Can Thierry and Anna make some comments on these particular areas? Anna, I would ask you to go first.
It's so difficult to say. I think so. Also, we are in very strange year. So what about in our mind now in the post-COVID area? Because many things are changed. So I think it's so difficult to think about single measure, single issue. So what we can try to build is create big areas, also to share best practices, and also to create more possibility to growth. I think now we are working in a very strange context, and so in my mind, for example, what was my thought last year, it's not my thought at present. So I think we have to build something in a macro area. I think would be very important.
Okay, and one of the areas there that, and I'll get Thierry to comment on this. One of the areas that a lot of people are focusing on, particularly from Italy, is the viability of things like mini bonds. But now, is there a case for a mini bond with an equity conversion, almost like a mini convertible bond? Thierry, I'm going to open up. That's an extra question just to make it a little bit more difficult for you.
Thanks. Cheers. So in terms of, it's absolutely correct that there is a lack of flow of capital into particularly the small small companies and seed investment, etc. in Southeastern Europe, and partly that's a cultural thing. So we talked, the whole conversation started off about banking and whether there is a room for capital markets, and the reliance on banking has has led to a lack of kind of education and understanding about investing in things like equity. And so taking equity risk is something that a lot of people are not comfortable with. So to me, part of the challenge is about education. It's also about making sure that there are sufficient rewards and risk mitigation tools, whether that be co-investment modules, having professional investors that invest alongside angels. There needs to be more of an infrastructure that is there to help get seed capital into the markets. And we've seen many different structures for that all across the world. In the UK, you have co-investment funds. In Italy, across Europe, you have all of these schemes. You have the venture capital model as well from the States as well, which is also starting to go into seed models. In the UK, for example, we've seen a very big pickup in terms of the amount of investment going into seed and Series A from private investors due to tax incentives. Those tax incentives creating, being able, having professional managers to create funds that can then invest, etc., etc. So I think infrastructure is important. Answering the question about mini bonds, because I can see Jim wanting me to wrap this up. I think mini bonds are probably too early for the market. I just don't think that they have a similar problem to lending, in that you still have to have capital to kind of start going with them. And a lot of the high tech, high growth businesses, whether that be technology, life sciences, etc., research driven businesses, which are coming out of the region, and which a lot of investors are looking for, they require a lot of incubation and a lot of financing to get to profitability. So mini bonds can be helpful, but I think it's something which even more advanced countries have failed. The UK, for example, one of the companies, Crowdcube in the UK, tried to launch mini bonds and it failed miserably. So there hasn't been the demand for it. I think equity is still the place where, small cap investment needs to be. Okay, well that's look, in the interest of time, because the last panel went over and I think we're going to go over anyway, I'd just like to do a very, very quick and for Peter, we've heard from many of the other panelists elsewhere. What is the role of the IFIs at the moment in this particular area for both the SME sector and also for the larger sector, such as infrastructure finance and municipal finance, where the requirements for funding are going to be huge over the next 2 years? Can you provide a little bit of feedback on what EBRD and other IFIs are doing?
Yes, indeed. I think there is a very important role for the international financial institutions in the region. It's not just financing, which you mentioned. Financing is very important, and the region as a whole is also very important for example, for EBRD. Just in the Western Balkans, we are investing well over 1 billion euros annually. But it's also very important that the IFIs are also focusing on building institutions, including the capital markets, but also in more general economic institutions, and which are necessary for example, for attracting the investors. And these dual roles are very important, because governments not only need the money to start different or finance different projects, but they also lack the capacity to manage these projects, implement these projects, and also to build the right institutions. And that's what will count later on when the epidemic will be over, is to have the right institutions and to help economic growth by attracting more investment in the countries. But of course, the traditional role is what you mentioned, is providing financing for large infrastructure projects, because energy infrastructure, transport infrastructure is still underdeveloped in the region, and it is also very much needed for economic development. Also, the municipal infrastructure will be very important, because people are leaving, especially the Western Balkans region, but also other Southeastern European countries in big numbers to work in Western Europe, because they don't find proper workplaces and the quality of life is significantly lower. So having the right quality, air quality, the normal quality utilities in the region is very important to keep talents, keep the people in place, and have the labor force which the investors will need later on. So we can help, as IFIs, we can help in all these through these investments, and also through these policy work, including supporting, for example, capital market development strategies, or participating in the issuance of corporate bonds, for example, which encouraging private investors to put money into investments, or investing along different in private equity with private equity investors. So all these can help through direct investment, through encouraging private investors, and through improving the business environment to help investment come to the region.
Okay, Peter. I'm going to do a very, very quick summary, because we covered an immense amount of ground, and then I'm going to open the audience up to questions. You can send questions to Polly Pentadou, who will be able to answer them, or will be able to ask them of particular panelists or of the whole panel in a couple of minutes' time. But in short, the general summary is we've got a very undeveloped capital market, but we're going to need to develop it, at least to provide some of the finance that's needed. The unresolved issue of capital markets, I think, most strongly is the access to finance for SMEs. It's a necessary thing that we need to address, but the question is, how do we address it? And what is the role of both private equity and public equity in that space? Rick Watson at an earlier session today actually raised the point that what these areas need is equity. Now, they may need emergency financing in the short run, and they may not be able to actually meet those repayments. So what is the mechanism for conversion of equity? Is it a capital market type of response, or is it a state privatization fund that takes some of these more distressed debts and then converts them, takes an equity ownership, and then basically at some point in time sells out that equity into the markets at a later date? What are the solutions there? The other problem is that we are beset in the region by legacy issues. And by legacy issues, I mean things like, from the privatization process, we have in many countries a couple of million share accounts which are non-active, completely dormant, and they're not trading. So that's one area that's basically impinging upon secondary market liquidity to a very large degree. But it's not the only area, and Thierry and Peter and Anna have pointed out other particular areas where we have a need to address the cost of issuing and the processes of issuing to make the markets more efficient. Finally, right, I think that one of the things that we have to recognize is that the financial markets are currently, there's cash in the financial markets. Insurance companies are under stress at the moment, but they do have cash reserves at the moment because an amount has not been drawn heavily on them. Interest rates are at their lowest level for many, many decades. So the debt burden is not going to be super high, but it is going to be significant in terms of real numbers. And these are the issues that we need to look at when we're looking to develop the capital markets. But the quick summary is, right, that the numbers are huge. We need international debt markets. We need the banking system. We need local institutional investors. There is no single answer in this particular area that we can possibly say is going to be the solution to all our problems. Now, Polly, we had a couple of questions, I believe, and you wanted to ask them?
We did. Thank you, Jim, and thank you all for this very interesting discussion. So the first comment we received is actually very interesting, and it reads as, significant financing needs are expected as a result of the COVID-19 crisis. And as was highlighted, sovereigns from across the southern eastern region have already started to issue on Eurobond markets. Do you expect that some of the government's financing needs will be in fact be met through local markets issuance, or has the extremely loose monetary policy in the euro area and beyond simply made it uneconomical to issue in local currency for many of these sovereigns? This is a question open to all participants.
Well, my quick answer is yes, they're going to need whatever markets they can get a hold of. Right. So that's my quick and dirty answer, but for a more sophisticated answer, I'll put it across to the panelists.
Well, I agree with you, Jim. I think the fact of the matter remains that, and we've seen this in many other circumstances, is that they'll probably tap up the local pension and insurance markets. I mean, that's a primary source for the governments of of raising capital. The one thing that makes me extremely worried is that you have quite large second pillar pension schemes that have grown quite rapidly and are doing pretty well, and there is always the temptation, as we've seen in places like Hungary, Poland, Russia, etc., for the government to dip their fingers and private public nationalize those assets. So that's the one thing that on the horizon that potentially worries me. But the answer is, in short, yes, I think they will tap up the local institutional market.
Anna, any comments?
No, I completely agree with Cherry. So there is the first choice is in the next future to have more public or more private in each country, but now we need money. So in any case, we don't care about it.
Okay, and I want to open up the elephant in the room to Peter Tabak, because I know he's got a strong view on this. Currency risk, Peter.
Yes, no, indeed, it's a very important issue. The good news is that local currency issuance by the sovereigns has increased in the region. So, and also the yield curve in local currency has increased significantly. But unfortunately, what we see is that the euroization levels have not decreased significantly. So in Serbia, euroization in the banking sector is still around 70%. In Albania, it's 50%. And the other countries are basically either using the euro or the currency is very strongly tied to the euro. So that's not such a good news, but at least we could see that the financial sector stability has increased significantly in the region. So the banking sector is liquid, the capitalization is very high, and they built up the NPL levels have gone down, so they built up significant buffers to withstand the effects of the crisis. So that's the good news. But on the increased government financing needs will also mean that they will rely more on the banking sector to finance the increased budget deficits. And already the share of government securities in the balance sheets of the banking sector are already very high. In Albania, around 25% of the balance sheet. In Serbia, it's also similar. And that means that basically this increased financing need is taking away funding from the private sector. So it's, and unfortunately there is no other institutional investor in these countries. There are foreign investors, for example, in Serbia, but it's mainly the banking sector who whom the government relies on financing. So that's why it is also important to increase further the institutional investor base. So it's not just the banking sector which would buy the sovereign issuance in local currency.
Polly, do we have any other questions there?
We do not have any other questions, but also I'm being conscious of the time.
So am I being conscious of the time. So I'm going to be conscious of the time and do a very quick summary again, right?
I think that you are perfectly in time. So
Okay, don't worry. I can never be accused of running late in this.
No, you are okay.
I'm very specific about timekeeping. One of the things that we do note here is that one sector of the economy is going to bear, or a number of sectors are going to bear the brunt of COVID reconstruction, but the ones that are have serious problems at the moment is probably going to be the municipal finance sector. But in all honesty, their receipts are normally in local currency, or at least linked to local currency. So they're obviously going to need to tap the markets at some particular point in time. Whether that's through the banking system or the capital markets remains to be seen. I would prefer to see it through the banking system, because one of the points that was made earlier, right, by Thierry Clark is that, and also by Peter Tabak, there's an overdependence on central government obligations in the capital markets, and this is something that we do need to change. So at this particular point in time, there's a large number of action items that I think we need to look at. We need to look at solutions for the SME market. They do appear to be immediately grant-driven and probably with conversions to equity, because that's the type of finance that they're going to need to get through this. We also need to look at the big ticket issuance to support government debt obligations, which are going to grow, but also infrastructure obligations. It's all very easy to say we can go to the international capital markets, but everyone's going to the international capital markets at this particular point. And at some point, that as a financing mechanism, right, becomes a little bit stressed. So during this particular period of time, we also need to tap domestic liquidity, because we know that domestic liquidity is still in the banking system. We know that a lot of the pension funds within the region are also long cash. So what we need to be looking at is ways to mobilise that capital in an effective way that's also both effective and safe for the people that are actually contributing the capital in the extent of institutional investors. So in brief, we've got a huge job here. Domestic capital markets are going to remain a priority in the region if we're going to mobilise capital. It's all very well talking about the international markets, but a lot of our borrowers cannot tap international markets, so we have to come up with solutions that will address that problem. IFIs have a role to play, but so does private equity, venture capital, so do applications like Investor Connected, which look to provide financing alternatives to SMEs. We need to look at a broad number of solutions in Southeastern Europe to ensure that the area doesn't lag further behind. Nevertheless, there's means for some optimism. This is a buoyant region. It shows itself to be able to grow at a better rate than Western Europe if the opportunity presents themselves and finance is available. So this is the one positive that I think that we could take out of it. I guess the other positive that we could take out of it is that, you know, pandemics are going to finish, financial crises do finish. At this particular point in time, it's important to remember that this is the period of time when we can actually execute valuable change for the next generation. So the role of developing capital markets will still needs to continue at this particular point in time. Now, with that in note, I've worked out that it's 16:11 according to me, 17:11. So we're at 57 minutes. Are there any final comments from the commentators? Otherwise, I'll look to close the session. Cherry, Anna, Peter? Everyone appears to be very, very happy. It's also been a very long day. In summary, we really want to see you in Trieste next year.
For sure.
It's a fabulous venue. It's lovely to see all your faces, but it's more important to see the audience and to sit in the piazza, having an Aperol Spritz and deciding what is important to the future development of capital markets. So I can only say to the audience, that's us done. Come and see us next year when we supercharge the program with Franco and the association's help. And we look forward to seeing you in Trieste in 2021. Thank you.
Thank you, Jim.
Thank you, Jim.
Thank you.
Thank you.